Welcome to the quarterly Storebrand Global ESG Plus webinar. My name is Spiro Salon, and today I'm going to be your host. I am joined by Lars Qvigstad Sørensen, Portfolio Manager for the Global Equities team, and Vemund Olsen, Senior Sustainability Analyst. First, Lars will give us an update on the Global ESG Plus strategy during the last quarter, and he will elaborate a bit on carbon emissions, whereas Vemund will present to us Sam's work on deforestation. We expect the presentation to take about 45 minutes, leaving time for Q&A. You can send us your questions to the chat function, and you can also do this anonymous. And remember, we will be sending you the materials and a copy of this presentation, the recording if you want, following this presentation. So with no further ado, I leave the floor to you guys.
Thank you very much, Alan. My name is Lars Sørensen, and welcome everybody. Happy that you could join. I'm very pleased to be filling in for your usual host, Henrik Nielsen, today. These are the topics we are going to discuss in today's webinar. First, we'll discuss some news, particularly news relevant to the fund's performance. Then we'll dive into the strategy's performance relative to the benchmarks, and then we'll dig into the attribution. After that, we'll do a thematic exploration, as has been usual during these webinars. Last time, you may recall, if you joined, that Henrik talked about the Science-Based Targets Initiative. And we're quite pleased that we've been able to incorporate this science-based targets into our portfolio strategy, because those are about forward-looking emissions, expectations about future emissions, and we think that's key. But this fund also looks at historic and current emissions, and for that we use another source called true cost. So I'll be exploring that a bit in the second part of the presentation, before I will give the floor to Vemund Olsen, our sustainability expert on deforestation. First, a brief introduction to the team and myself. We are a team of 5 portfolio managers, and we have a rather diverse background. Some come from physics, some from engineering, and 2 of us from financial economics. I am Lars Sørensen, and I have been in Storebrand since 2011. Prior to that, I worked for MSCI in research in California and in risk metrics in Geneva, and I also worked for NBIM, the Norwegian Government Petroleum Fund. Okay, so quickly and briefly, a little bit about some relevant news. So the energy market has been given most of the headlines recently in the financial news. A shortage has increased prices and also demand. So the cold European spring and a hot Asian summer increased the energy demand. Increased industrial production has also boosted demand for liquefied natural gas. However, Russia has been supplying less gas than usual, and there's been little wind in Europe this summer. Also, hydropower has suffered from droughts, so renewable sources have not been able to deliver as much as they usually do, and there have been shortages in fossil fuels as well. And it's not all that easy to substitute to the most dirty forms of fossil fuels, for example, coal, because of much higher quota prices in the EU. So given these increased commodity prices and fossil fuel prices, it's perhaps not surprising to see that the GICS energy sector has been among the best performing sectors, with 1.3% as measured in US dollars. This fund, this strategy, has no investments in the energy sector because all those companies are excluded on the fossil fuel criterion. Virtually all of them are fossil fuel companies. So one would think that all else equal, energy doing well and these high commodity prices would lead to a negative contribution to the fund. Also, clean technology renewable energy has underperformed in the third quarter. The S&P Global Clean Energy Index, which I think is the most widely used renewable energy index, posted negative returns in the third quarter. It actually underperformed MSCI World by 7.4% and the MSCI Energy sector by 8.8%. These returns are measured in British pounds. So it's been a challenging quarter for renewables, and they continued their poor trend from the first half of 2021. Added to that are higher quota prices. The ETS quota prices increased 29% during the quarter. And this means that it's more costly now to emit greenhouse gases, and it's more costly to pollute in Europe than it was before. So it's not so easy to substitute energy sources. On this slide, we have three different charts. They are futures prices for three fossil fuels. In the leftmost pane, we have the Brent oil futures price, the nearest future, and it's increased 5% during the third quarter. And here comes the big one. The gas futures prices, as measured by the Dutch futures price, increased by 182%. As I'm sure most of you are well aware, gas prices are astronomical at the moment. And even coal, the dirtiest of fossil fuels, increased by a lot in the third quarter, 62%, as measured by the Australian Newcastle coal futures. So commodity prices and fossil fuel prices increased by a lot in the third quarter. But despite this, not investing in oil and gas companies only detracted 2 basis points from the fund's relative return. So this may perhaps seem smaller than expected, and we'll try to dig into why a little bit later. First, let's have a look at the performance numbers. So the third quarter was another strong quarter in terms of absolute performance. This is measured in euros. So the fund posted 2.32% absolute return, and this was identically equal to the benchmark's return, thus maintaining a consistent track record of positive returns. We see that intra-quarter there was actually quite a bit of variation in the relative return. The high point of relative returns was in the middle of August, where the fund was 53 basis points ahead of the benchmark in this quarter. However, that was neutralized toward the end of the quarter, and we ended, as I mentioned, exactly at 0%. This was perhaps due to energy companies doing very well in that latter period. So if we have a look at returns over different time horizons, then we see that the third quarter posted absolute returns of 2.32% and 0 relative returns. Year to date, absolute returns are very high, more than 19%, and we're 26 basis points behind the benchmark. If we look at the 1-year returns, absolute returns are north of 30%, and we're 19 basis points ahead of the benchmark. If we look at horizons of 3 years and since inception, the numbers have been annualized, and we have strong absolute returns and quite large outperformance. This is in some part due to ESG actually performing really well during this period. Now let's have a look at the attribution. So here I'm considering only the equity part of the attribution. I'm not considering currency effects. And this is because the currency risk is almost completely hedged at the fund level. So we think it's most interesting to disregard that when we look at attribution. In this waterfall chart, I've sorted from the largest positive to the largest negative contributions to relative returns. And we see that the screens actually gave us a bit of positive relative returns, in particular the Storebrand Standard, which is a list of companies that the worst performing in terms of ESG that have been excluded from the investment universe. So these are companies that are either excluded due to the products they make or a norms-based exclusion. Products could be controversial weapons such as cluster munition, and the norms-based screening could be, for example, corruption. So the Storebrand standard contributed positively by 17 basis points. The ethical screen, i.e. not investing in alcohol, gambling, etc., contributed positively by 11 basis points. And the fossil discretionary screen, that's a screen taking out fossil companies that are not excluded through data we get from our vendors, such as true cost, but it sort of takes out companies in the fossil fuel value chain. As we saw, fossil didn't contribute much at all, only -2 basis points, but a large negative contribution this quarter was ISS ethics. And that's a screen which we have chosen to include in this fund. It's a standard in all Swedish funds, and we use it for this strategy. And the company that contributed almost all of those -14 basis points it's Tesla. So Tesla is excluded on labor rights. As we saw on the previous slide, Climate Solutions contributed negatively by 8 basis points. I'll try to explain what those 8 basis points consisted of. We see that renewable energy continued its poor performance during the third quarter, so -8 basis points contribution from renewable energy. Recycling was also a negative contributor, and water utilities made the largest positive contribution. So it was a mixed bag, but renewable energy in particular stands out with a negative contribution. So in total, Climate Solutions contributed negatively this quarter by -8 basis points. Here's a summary of the performance attribution for the third quarter. In the upper left corner, the table shows an expanded version of the waterfall chart I showed you on the previous 2 charts. And what stands out is the Storebrand standard contributed positively, and not owning Tesla in this fund contributed negatively. If we look at the bottom left corner, we see the 3 companies that contributed and detracted most from the relative return in this quarter. So what is often the case is that among the largest relative contributors are solution stocks or excluded stocks. And if we look at the positive contributions first, we see that Daikin Industries, which is the solution stocks, they provide energy efficiency in buildings. They contributed positively by 5 basis points. Shimano, another solution stock producing bikes, which are labeled green transport, contributed positively by 4 basis points. Omron Corp is a Japanese electronics company. It's not a solution stock, but we do have an overweight in the company, and it contributed positively by 4 basis points. On the negative side, Tesla, as I mentioned, is excluded for a violation of labor rights. And Tesla did really well this quarter, and thus not owning Tesla yielded a negative contribution of -14 basis points. Costco is excluded on the fossil fuel criterion, and Shell obviously is an oil major excluded because of oil. The 2 last ones yielded a negative contribution of 4 basis points both. If we look at the strategy since its launch in 2016, we get a longer picture, and here we have to look at the Swedish equivalent of the global strategy, because that's the one that has existed the longest. But the strategy is identical across markets. So since 2016, if we look at cumulative numbers, not annualized, and gross of fees, then the fund is more than 14% ahead of MSCI World, which is quite a bit. The largest positive contribution to that outperformance has come from not owning fossil fuel stocks. In second place, we now have the Storebrand standard, so avoiding the ESG laggards, the worst companies, has yielded a positive contribution, and so has climate solutions. They are both north of 3% since inception, with their positive contribution to relative returns. Okay, so that was a brief overview of performance numbers and an attribution. And as we usually do, we have sort of one theme that we explore in a little bit further detail. And I thought it would be fitting to look at carbon emissions this time, because I think it goes well with the science-based targets initiative that Henrik discussed last time. They sort of go well together, I think. So just a reminder, there are two main pillars of Paris-aligned investing. It's one, you need to decarbonize, and in order to do that, you need to invest heavily in climate solutions. So decarbonization and investing in climate solutions, i.e. renewable energy, are both core to achieving the goals of the Paris Agreement. Most climate-aware funds, they do report their carbon emissions in some form. They may use different metrics such as carbon footprint, carbon intensity, etc. We use data from a vendor called Trucost, which is an S&P company, and focus on CO2 intensity. And on this crowded slide, we are comparing our strategy to climate index strategies. And across all these different categories, our fund does really well compared to the climate indexes. We have carbon intensity, carbon risk, fossil revenues, and science-based targets. But here I'd like to focus on the Trucost carbon intensity. So we can see that our number is low. These are numbers from a couple of months back, but they are virtually unchanged. Our strategy has a very large reduction in carbon emissions as compared to the benchmark MSCI World. But we see that some of the other climate indexes, they actually have lower emissions. And while we acknowledge that they have achieved that, we have chosen not to do so. It's a feature in this fund, it's not a bug. We think that our approach is superior. So let me detail why. If we look at funds and indexes that market themselves as low carbon funds, we see that they run into some dilemmas. Many of them often still count oil and gas majors among their largest holdings. And this is because the use phase emissions, the life cycle emissions, especially scope 3, which I'll discuss in a moment, they're not included in optimization. And what they often do is that they reallocate along the value chain. They invest heavily in oil supply, etc. And companies that we actually believe are more exposed to climate risk and more exposed to stranded asset risk than the oil majors themselves. So what can end up happening is that you can actually underweight climate solutions due to a lack of life cycle emissions data. And I've tried to illustrate that here with two images. One is a solar panel and one is black exhaust coming from a combustion engine. And so the question is, what are the emissions from sort of these two companies exemplified on the next? I forgot I was going to have a little bit of a detour into the scopes of emissions. So scope 1, those are the emissions from direct operations, which are controlled by the company. Scope 2 are emissions from consumption of purchased electricity or energy. And scope 3 is all other emissions. So that's the entire value chain, upstream, downstream. And as you can imagine, scope 3 is much, much harder to measure than the others. So back to our previous picture. So I've tried to exemplify this with two companies. One is a solution company that we own in the solutions part of this portfolio, Scatec Solar, a solar panel company. And the other one is Volkswagen, producing, among other things, fossil fuel cars. And so if we look at scope 1, direct production, Scatec has 9 as their intensity and 25 in scope 2, purchased energy. So 34 in total, whereas Volkswagen has a bit higher in scope 1, 16, and 21 lower in scope 2, so 37 in total. So if you naively optimize on carbon emissions, these two companies would look equally good. But if you include scope 3, and recall that scope 3 data is notoriously unreliable, but these are the true cost measures, then you see that emissions associated with producing fossil fuel cars are much higher than for producing solar panels. And this is not even including something which is called scope 4, avoided emissions. So the point is that optimizing solely based on scope 1 and 2 can yield some undesired results. So life cycle emissions, while they're really hard to measure, can be key to allocating to solutions. Scatec Solar is a solution company which we own with a large overweight in this portfolio, this fund. Fossil fuel cars contribute, on the other hand, negatively to emissions. Here's a bar chart showing the emissions by GICS sector in MSCI World. So what stands out here is that MSCI World is the total is listed here as the red dashed line. So what stands out to me here, at least, is that some sectors have very low, while others have very high emissions. And it's only 3 sectors among the 11 which have emissions above the average of MSCI World. Here's a comparison of our fund versus MSCI. So what I'm doing here is I'm computing the cumulative contribution to the total by sector. So using data as of the end of September, MSCI had 136 in CO2 intensity, whereas our fund had 56. And what we see here, so that's a 60% reduction versus MSCI World. And what we see here is that our reduction versus MSCI World is achieved by our allocations in 3 sectors. And those are the highest emitting sectors: energy, materials, and utilities. As you can see, the pink or red bar at energy is at 42, same as it was for industrials. That's because we have a 0 weight in energy, but we do have benchmark weights in the 2 other sectors. And so what we do there is that we invest in less in companies emitting less carbon. So it seems that funds, and some do, could have low emissions by avoiding investments in energy, materials, and utilities, but that would be a thematic fund, or it would be a poorly diversified fund, and it would produce no energy. So clearly the world needs energy. So what we do instead is that we replace the missing energy allocation with utilities allocations producing renewable energy. In the interest of time, I'll be very brief here, just mentioning that among the top 10 contributors to CO2 emissions in MSCI World, 7 are excluded on the fossil criterion, meaning that we have 0 investments in them. 1 is discretionarily excluded, and 1 is a voluntary 0 weight. And 1 stock, Linde PLC, has half the benchmark weight. RWE, which some renewable funds like, is excluded on the fossil criterion here. Finally, I'm showing here that we are not achieving those low emissions by not investing in high emitting sectors. So our optimization algorithm actually seeks to have equal sector weights as the benchmark where it is allowed to do so. So it's prevented from doing so in the energy sector because all those are fossil fuel companies, but the utilities weight is identical to the benchmark, and we're not avoiding sectors with high emissions. In fact, it's a fact that some solutions have high carbon emissions, or they have carbon emissions. Our own Storebrand's own analysis has identified 145 companies to which we allocate 10% of the fund. And some of these solutions, they do require carbon emissions. And what we have done is that we have said, okay, we acknowledge that they emit carbon, but a careful life cycle analysis shows us that they contribute very positively to the climate. So we don't want to penalize Scottish Solar or Rockwool providing isolation materials for their emissions in scope 1 and 2, because the life cycle climate contribution is very positive. And as you recall, some of these solution categories actually then have higher CO2 emissions than the benchmark. And we don't penalize them for that because their net climate effect is positive. So a careful life cycle analysis is needed in order to achieve the fund's goals. Investing only in low emission sectors is not the answer. We try to invest as closely as possible to the benchmark weight, except in the energy sector, which is excluded due to the fossil criterion. And fossil exclusions in the utility sector have been replaced with renewable energy alternatives. So as a summary, performance-wise, fossil fuel prices continued to increase and green solutions underperformed. But our strategy had identical performance to MSCI during Q3, benefiting from positive contributions from investment screens. Our fund has reduced the CO2 intensity by approximately 60% compared with MSCI World. And when we consider carbon emissions, we employ a holistic life cycle approach where we avoid naively optimizing on true cost scope 1 and 2 emissions. And with that, here's a final slide from me. Many climate-aware funds focus most of their attention on the energy market, where coal is the unique worst emitter among the energy sources. But this is a chart taken from The Economist on October 2nd, 2021. And I thought it was quite interesting because it also shows us that food production can be a large source of emissions. And in the very right tail of the scale here, we see beef production. And beef is very carbon intensive due to both methane emissions and pastures created by deforestation. And so this fund, our strategy actually does not invest, it excludes some of the most intensive meat production companies. I thought this would be a nice place to end and give the word to Vemund, who will talk about Storebrand's management of deforestation risk.
Thank you very much, Lars. That was a good segue. Thank you very much, Lars. My name is Vemund Olsen. I work in Storebrand's risk and ownership team. Just a slide to show you where we are 6 persons currently based in mostly here in Oslo and in Stockholm with a very diverse background. Myself, I joined in May this year and I have worked on deforestation and finance for the past 13 years. So I'm very happy to be able to implement Storebrand's strategy on deforestation. Next slide, please. So deforestation has been on the agenda and it has been in the media for a number of years. There's been a lot of focus on companies contributing to deforestation, and increasingly I think that investors are waking up to the financial risks that are arising from this activity. So as some of you may know, tropical rainforests are essential to preventing dangerous climate change as well as species extinction. And that's why Storebrand, in its climate policy, we take an ecosystem-based approach. We do not look only at the energy sector, but we also look at emissions from land use change and deforestation specifically. So forests provide ecosystem services or natural goods that a lot of economic sectors depend on, and causes physical risks like reduced rainfall, which obviously has negative impacts on the agricultural sector, floods, loss of biodiversity, temperature rise. And we see that as that is being picked up by increasing regulation in several countries, financing deforestation is becoming increasingly risky. The United Kingdom, the European Union, the US are all working on due diligence laws that will try to bar commodities that come from recently deforested areas. And currently, companies working in this space, unless they radically improve their ability to demonstrate that their products are deforestation free, will likely have loss of market access. So ending deforestation will not only be good for the world, we believe that it will also drive shareholder value. Next slide, please. Yeah, this is a visualization of some of the financial risks involved or arising from deforestation, but I think we can pass to the next slide. So Storebrand adopted a policy on deforestation 2 years ago in 2019. Our ambition is to have an investment portfolio that does not contribute to deforestation by 2025. And that's still a few years from now, but it's quite an ambitious target. And currently, at the upcoming COP26 in Glasgow, there has been a call for the financial sector to adopt exactly this goal, to become deforestation free by 2025. And we're taking a leading role in trying to mobilizing other financial institutions to join us in this endeavor to become deforestation free. And I'll give you a little taste of why we couldn't do this sooner, and to show you some of the challenges in achieving this target. Next slide, please. So to be able to have a deforestation-free portfolio, we needed to assess to what extent are we actually exposed to companies with that may be contributing to deforestation today. And differently from the energy sector, there are very few globally accepted methodologies to do that. So we had to start by doing a broad assessment of the available tools and data sets that investors may use to assess the risk exposure of their portfolio. We produced a report, which you see the cover of to the right, last year, and has been using that in our dialogue also with other financial institutions to get their input and to share some of the learnings that we made. We found that there's not one ideal tool that will fulfill all investor needs in this field as it is. But we devised our own methodology based on two of the data tools that exist today, called Forest 500 and Trace, in which we assess the company's risk management and risk awareness and their exposure. So we mapped the companies included in the Forest 500 database to our public equity portfolio and identified 120 companies and 90 financial institutions that have some kind of deforestation risk. Next slide, please. Most of those companies have what we call indirect exposure. That means that they're not present in forest areas actively cutting down forests. There are food producing companies, financial institutions that have an exposure through their supply chains, through the commodities that they source, or through financial relationships, banks that provide loans for agricultural companies, for instance. So based on an assessment of the strengths of these companies' strategies and policies, and based on how how high exposure they have, how close they are to the deforestation that's actually happening. We selected 50 companies for ownership engagement. Next slide, please. When we talk to these companies, our expectations center around these 4 issues. On strategy, we expect them to have a deforestation policy with quantifiable time-bound targets. We want them to have good governance, awareness regarding deforestation risk, that they should be able to trace and monitor their supply chains, and that they should have systems in place to ensure that their suppliers are actually complying with their deforestation policy. We've seen that there's been an explosion of commitments and policies on deforestation, but research shows that it's very difficult to ascertain whether companies are actually in compliance, because there are currently no standardized measurements for how these policies should be set up. And that's something that we are working with research institutions and organizations to improve, especially to make sure that the ESG data vendors integrate best practice in terms of measuring deforestation practices in their data sets. Next slide, please. When we work on deforestation, we use all the tools that we have available in our toolbox. Engagement, I've already addressed. We try to team up with other investors to gain more leverage when we speak to companies, if and when there are collaborative engagement processes going on. From the close to 50 companies we selected, unfortunately, we are having to do it alone with about 40 of those companies. These are companies that may not have been on the international investors' radar so far. But we are working to recruit more allies in terms of reaching out to these companies to be able to have a larger impact. We use proxy voting. That's an important part of our strategy. We see that there haven't been a lot of shareholder resolutions on deforestation so far. This year we co-filed a resolution to the big soy trading company Bunge at their AGM, requesting the company to improve its forest management practices, which passed with a 98% approval rate. And that's something that we're hoping to do more of. We're looking into the possibility of integrating deforestation risk into our internal rankings, and we have chosen deforestation as one of the voluntary principle of adverse impact indicators under the European Union's sustainable finance disclosure regulation requirements to help us get better data to be able to integrate that into our ranking. And divestment, while it is not our not our preferred tool in this field, we will divest companies that we feel are unable or unwilling to improve practices in accordance with our expectations. Next slide, please. So these are some headlines from the news. I mentioned that there have been a lot of focus on deforestation in Brazil and on investor engagement, and Storebrand has taken a leading role in engaging not only with companies but with governments. Next slide, please. We see that while it's important to engage with companies, it's not enough. Often it's not really within the power of companies alone to handle these issues. We need to see better regulations from governments, both in supply side countries, meaning countries where commodities are produced and where forests are being cut down, as well as on the demand side, such as Norway, the UK, the European Union, the countries that import the commodities. So Storebrand co-founded and is co-chairing the Investors Policy Dialogue on Deforestation, which is an alliance of about 45 financial institutions with approximately 7 trillion US in assets under management, which is engaging with the governments of Brazil and Indonesia to request stronger regulations to ensure sustainable land use and forest management, as well as respect for human rights. And I think this is quite a first. I mean, this is an innovative experiment. Investors like ourselves have mostly focused on engaging with companies, but we're seeing that through this engagement with the governments of Brazil and Indonesia, we have, I think, opened increased the space for Brazilian companies to engage with the government and request better standards. The current climate in Brazil, a lot of companies try to lay low and not really risk infuriating the government, but through this initiative, we see some of Brazil's largest banks and companies speaking up and requesting much stronger standards, because they see that there is very significant financial risk with the negative reputation the country has been getting in terms of its increasing deforestation rates. So while we cannot claim to see any significant positive changes in the rate of deforestation, unfortunately, we are seeing that there is a lot more focus on this from the private sector within Brazil, which we think is a positive development. I think that is the last slide, and I probably spent all the time that I had, but I'd be happy to take any questions now or at a later stage. Thank you very much.
Thank you very much, Vemund, and thank you very much, Lars. We have one question here in the chat, which I'll read back to you. Do you invest in nuclear energy plants as part of the solution portfolio?
No, nuclear is not part of the solutions portfolio. In fact, there are no nuclear investments in the portfolio at all. There are some companies in the energy sector, GICS sector 10, which are nuclear, but we've excluded the entire sector. So this remains a much debated topic, whether nuclear is part of the solution or not. And the EU taxonomy has gone back and forth as to whether nuclear power should be taxonomy compliant or not. But at this stage, we do not have any investments in nuclear power.
Thank you, Lars. Vemund, do you have any comments from a sustainability perspective from your side, or otherwise I'll go on to the next question? I've actually gotten a question on email, and I urge people to actually send the questions to the chat. But the question I've gotten is, obviously at the moment there is an energy crisis in a way as the oil price is going up. Do you have any thoughts around that, as energy is one of your intended risks, or I guess being fossil free is what they mean here?
Yeah, so in 2020, this fund outperformed MSCI World by much more than we could have expected. Renewable energy outperformed MSCI World by close to 100%, I think. So it was a massive year for renewable energy. And we've seen a bit of a reversal this year. But going forward, it's going to be very interesting to see what happens, because one thing that we see is that while oil prices are high now, the oil majors are not really increasing their capital expenditures. Those are declining, actually. So perhaps the solution might be to continue investing in renewable energy and improving power sharing facilities through the grid, for example, between countries. But it will be very, I mean, we're in the midst of this energy crisis now. The head of EIA said that that this should be a further impetus to increase our allocation to renewables. But it is one of the intended risks of the fund. Yeah.
Thank you, Lars. And then I see there's no more questions coming to the chat. I have one last question, actually, something close to heart for a lot of the people we talk to. It's to you, Vem, and then it has to do with the COP26 coming up in Glasgow. We also have people participating from the UK. Do you have any thoughts about what you would like to see coming out of that gathering, and maybe specifically on deforestation? Is there any thoughts you want to share with us on that?
What I would like to see? Well, obviously we've seen that. I guess I can't really add anything that not most other people could. But of course, what we've seen so far is that the national targets have been completely insufficient to reach the goals of the Paris Agreement. We've seen John Kerry stepping up and saying that he has very high hopes, that he knows about a lot of countries preparing much more ambitious national plans, and fingers crossed that will happen. I also hope that we will see a strong reply from the financial sector to the call for action from the high-level climate actions and Mark Kearney, as well as the COP presidency, for financial institutions to adopt very ambitious targets for the emissions reductions from scope 3 or from their investments, including on deforestation. So I think that's still there's intense work going on all the way up until the COP, but I do hope that we will see some exciting announcements from large international institutions following us in this work on deforestation.
Thank you. Something tells me the next quarter's webinar will have something to say about COP, I guess, but thank you about that. All right, Lars, Vemund, I don't see any more questions coming in through the chat, so on that, I guess we'll wrap up, and I'll just remind people that we will send them the materials and a recording of the session at a later date, but you're all welcome to reach out to your advisors in the meantime if you have any questions. Thank you, everybody.
Thank you very much.
Thank you.
Bye-bye.